the program for the day, and maybe even explain why we're having this forum. The program is, as you see it, the morning is mostly me and then the different speakers we have talking about liberalization, digital solutions, etc. The afternoon is to cover the banking sector and the opening up. So please be patient. I think it's important to have context as to why we're here. Why are we opening up now? Why didn't we open up before? You know, did we have an open economy before? So historical context is important to understanding the opening up of the banking sector now as part of a process. It's not an event on its own. Okay, if we go back and look at Ethiopia, 60, 70, 80 years ago, we had an open financial sector. We had an open economy. And that seemed to be working well until we had, in 1974, the change in regime and the change in economic policy. We went from having one of the freest, most open possible economies. There were no restrictions on foreign investment of any kind. We had multiple banks operating. We had multiple insurance companies operating. We had foreign investors in agriculture, manufacturing, services. Even the Addis Ababa Stock Exchange was significantly owned by foreign investors. So we have this experience. It's not new. We look at the banking sector opening up now, and it's like it's a huge event, unprecedented event, and it's not. So the DIR came in, and we went from this very liberal, very open economic policy, financial sector policy, to the extreme opposite, where we shut everything down, and we went into our cave. Not only were there no foreign players in the financial sector, there were no domestic players in the financial sector except for the state. So that lasted for 17 years, and it cost us a lot. Then we had the new regime. That regime came in, and it was, again, very open market. I mean, within 3-4 years of the new regime coming in, we were off on a huge privatization push. We privatized a lot of entities, a lot, including some really big entities. And then somehow, and that lasted for about 10 years. I remember we used to have public debates, and there were a lot of public debates about economic policy, financial sector policy. You know, should we have a stock exchange? Should we not? Should we allow foreign banks? Should we not? It was debated, and actually government was a very strong advocate of open market policies, except for the financial sector. Then, about 17, 18 years ago, came GTP1 and GTP2. Because the free market policies that had been adopted didn't seem to be working. The economy was stalling, growth was anemic, inflation came and went. Keep in mind, I moved back here 26 years ago. When I moved back to Ethiopia, the GDP of Ethiopia was $4 billion. $4 billion. Of course, the population was much less as well. So that was the economy that the new administration inherited. So in the space of 30 years now, we have a $100 billion economy. The economy has grown, it's gotten complicated, but in a lot of ways it's still constrained. So the free market policies we adopted very aggressively, coming out of the socialist regime, lasted 8-9 years, and we changed strategy to a state-led model because that policy wasn't working. I mean, these big changes have reasons. They don't happen out of context. So it's, okay, I'm a strong advocate of free markets, open financial systems. And someone might say, well, we tried that and it didn't work. Well, it's how you try it and the timing of when you try it and the state at which the economy is in. You have to be ready for a free market. Okay, you have to have a comprehensive set of policies and building of local capacity. I mean, that's a whole other different conversation. But, you know, keep in mind, we had 17 years where the private sector was completely decimated. The financial sector was gone. So all of a sudden, you come up one day and say, okay, now we're going free market in a competitive world where we haven't built any kind of capacity. We're starting from zero. And we know the history of all economies going back, you know, hundreds of years. Any economy that comes out of a pre-market, kind of agrarian, very low-level development economy, for it to take off, for it to grow, for it to transform, there needs to be a big push. It's classic economic theory. Okay, what is the big push? The state has a big role in the beginning of pushing the economy to take off. What is that? Building infrastructure. Without infrastructure, there is no private sector, there is no economic activity. Infrastructure of all kinds. Physical, roads, power, etc., human capital, and very, you know, institutional capacity, you know, hard infrastructure, soft infrastructure, and very importantly, financial infrastructure, without which none of this works. Okay, so the role of the state, you know, we jumped this initial, you know, we came out of the socialist regime, there was nothing, you know, whether it's in terms of, okay, there wasn't enough. Hard infrastructure, soft infrastructure, or financial infrastructure. So without building these, and this, you know, it's not building buildings, it's building institutional capacity. It's building human capital. That you're then in a position, and you have infrastructure and you have, you know, everything you need, that you're then in a position to adopt free market policies. So you adopt free market policies without doing this, it's not going to work. And that's what we saw. So the measure that was taken with the introduction of GTP 1 and 2 to provide this big push is correct. And it worked. It could not work. I mean, a lot of money has to go into the big push. Fortunately, Ethiopia was in a position where it could borrow, got foreign direct investment, even issued a Eurobond. And that money was used to build this infrastructure. The government was investing 35% of GDP in infrastructure. That's a big number. And the growth we saw comes out of that investment. Okay, that's one leg. Financial infrastructure, though, didn't move. Okay, it's like a person who grows up and has, you know, strong bones and muscles, but no heart, no cardiovascular system to make it work. So we've built all of this infrastructure at great expense, but that infrastructure doesn't do anything unless there's activity, and the activity comes from the private sector. You build roads. If you don't have trade, the roads don't do anything. Okay, same with all, you know, you have educated population, no private sector to create jobs. It's a little bit wasted. So why did Ethiopia not build its financial infrastructure the same way it built its hard physical infrastructure and soft human and social infrastructure? Was it an oversight? Was it not understanding that financial sector was necessary? No, it was a political decision. Okay, if the private sector wasn't going to build a financial infrastructure, then somebody had to, and the state assumed that role. How did they assume that role? So with a state-led model and a big push approach, government takes on the job of deciding what sectors of the economy are competitively preferable. Okay, where we might have a competitive advantage, either in replacing imports, supplying local demand, or exporting. Government decides what sectors are priority. And then government funds those sectors through state institutions, as we've seen with the Development Bank and Commercial Bank to some extent. So government consciously decided that we did not need to have a private sector-led financial infrastructure because the state had assumed that role. Okay, seems to make sense and might have been appropriate for some period of time. But at some point, in economies, it grows, progresses over time, it changes over time. In this early stage, when we were basically coming out of a pre-market economy, socialist economies are, not market-driven, and we're transitioning to a free market, market-driven economy, it's kind of simple. The economy is simple. Back then, it's a $4 billion economy, mostly agriculture. No private sector, no industry to speak of. No service sector. So it's a much easier job to kind of look at this and say, okay, let's do this, let's do that. And for the government, to some extent, to be able to manage this process. But as the economy grows, it gets more complicated, it develops more. It's beyond the capacity of any institution, any individual, any government to plan big, complex economies. And that's the experience we've seen globally. It just doesn't work. So you have to move to private sector solutions, free market solutions, because markets provide a platform, a medium, where all players, okay, suppliers, consumers, government, financiers, everybody gets to vote in how resources move, resources are allocated, what sectors should grow and what sectors should not, because financial markets do that. Financial markets provide a platform where informed investment decisions can be made. I'm talking about the full gamut of financial markets, which we haven't gotten to yet. So this process we're seeing now of accelerated financial sector liberalization is basically catching up with what we failed to do over the last 17 years as all other parts of the economy and all other parts of our infrastructure grew and our financial sector didn't, and it's become a bottleneck on the economy, and it's become very clear that it is. So I look at this opening up to foreign banks as part of a delayed continuum. We're way late, and it's only a little piece of what needs to be done. So going back to the new administration coming in, we started with privatization. We allowed private banks. There were no private banks. I remember, I was here when they allowed that. Then we allowed private insurance companies. And then it stopped. The next step, I remember 20 years ago, I was advocating very strongly for capital markets. A stock exchange which we had back in the 1950s. It's that stock exchange that gave birth to all the state-owned companies we have now. Where did they come from? All of the big ones. These were share companies that were enabled by the infant capital markets we had even back in the 50s and 60s. You know, without the Addis Ababa Stock Exchange back then, we wouldn't have these state-owned companies, both the ones that have been privatized and the ones that we still have in state hands. They weren't built by the state, they were built by the free market. There were a few exceptions, factories built during the Derg and so forth. So that process was started, stalled. The results weren't good. They were good for a period. Okay? Once you achieve liftoff and the economy gets complicated, market forces have to take over in deciding where resources are allocated, how they're priced. The government has been trying to do that, and it's not working, and it's become very clear. So what are we doing now? We're on a very accelerated pace of liberalization, which is way late and very appropriate. One of the things we have to be careful about is financial markets are sophisticated, complicated, require a lot of human knowledge, require knowledge and information to be freely available. So you have to build those. There are institutions that make financial markets work. And without building them, you can't get a properly functioning financial market. So it's like driving a car. You start with first gear, you go to second, you go to third, you go to fourth. Sometimes you can go from first gear to third, but you know, you can't go from first gear to fifth gear and expect the car to not sputter and stall. So, you know, when I look at the opening up to banks, foreign banks, that's a huge plus. I think we're not rushing that at all. We're way late. In the afternoon session, we'll discuss, okay, what banks might come, why might they come, what might they do, etc. You know, what does that mean for local banks? Is it an opportunity? Is it a threat? What does it mean for the financial sector? You know, what does it mean for insurance companies? What does it mean for microfinance companies? You know, we talk about banks, but you know, today's banks aren't the banks of 20, 30 years ago. You know, one of the things we should have in the back of our minds is if we look at banking across Africa, all the big international banks that used to dominate or were active in Africa, you know, Citibank, HSBC, Barclays, they're all packing up and leaving. Why? Lots of different reasons, which I'll get to in the afternoon session on African banking. So who's coming? It's probably Pan-African banks. Okay, why are they coming? Well, it's a big market. Banks like big markets. They like consumers these days. They're not interested in the corporate clients as things used to be 20, 30 years ago. So, you know, when you put in context who's coming and why they're coming and what they're going to do, what it means for local financial institutions, we'll cover, you know, in depth this afternoon. What does it mean for the consumer? What does it mean for corporates, etc. I'm sure, you know, insurance won't be left out. We haven't heard anything, but I can't imagine why that would be left out. Basically, the microfinance sector is being opened up because the banks coming are going to do microfinance. Capital Markets Authority, Stock Exchange, it's coming. Great. Again, needs a lot of institution building. It's quite different. You know, in financial markets, you have banks and you have investment banks, which is what drive, you know, like banks drive the credit markets in you know, less developed countries and other places. It's bonds, all kinds of debt securities, again, that get sold in the securities markets. But when you're looking at stock exchanges and equity instruments, and you're looking at selling them to the public, that's a whole, it's finance, but it's a whole different game. It's a whole different set of institutional capacities. It's a whole different set of professional capacities and so forth. So That'll require some building, but we're in a position right now where we have an informal stock exchange. I mean, I don't know, lots of banks, insurance companies, companies in other sectors. I don't know what the number is, but I wouldn't be surprised if it's 100. It's well north of 50. Fairly decent-sized public share offerings that have been done, and you've got share companies, and there's no stock exchange. And these shares trade hands informally. There's no pricing, there's no transparency, it's a negotiation. Okay, so in a way, where we have a stock exchange and it might be easy to pick up quickly. The stock exchange that gets set up in Ethiopia might scale up very quickly because it's not going to wait for IPOs. The IPOs have been done. They're waiting for a secondary market, which I think they'll all hop on. So again, even in the developed markets, share trading, share valuation, all kinds of issues that come with equity securities we haven't seen yet, and that's a capacity we'll have to build and learn as we go. But all of these liberalizations, as important as they are, will be compromised until we do the one most important liberalization of all, which is the biggest problem this economy is facing now. It's the exchange rate regime, which I believe is at the root of many of the problems we're seeing. So, some people might think, oh, we're not ready for that. How can we do that? And this and that. It's part of a continuum. Okay? It's bigger, more fundamental, cuts across everything, which is precisely why that is the one important liberalization which we have to take and which I believe is in process. Okay, how do we do that? Can we do that? I've talked before many times about how it's possible and how it's doable. And if we have time, I'll get into that. But so this is the historical context of where we are now with the banking sector opening up. Okay? I'd like to touch briefly on why it's become so apparent that this needs to be done, because context, again, is important. We're talking about the Ethiopian economy. All of the policy measures that we take are to make the economy work better. So I think it would be interesting to see a few charts that kind of show some of these key variables that are affected by financial sector activities, or activities that should happen. What's the biggest symptom of the underlying constraints and imbalances that we see, that everybody is aware of now and the public is aware of now? The red line is inflation, and the black line is GDP growth. And you can see how they've really started diverging starting in 2017, 2018, and really accelerating. This is a bad chart. And then you look at the trend lines. Okay, we haven't done any forecasts because, as far as I can tell, it's quite unpredictable. But inflation is up approaching 40%. And this is kind of the general inflation number. Depending on the basket that you're using, And maybe if we looked at the typical person in this room or the typical person in Addis, the basket might show an even higher rate of inflation. Okay, and then the GDP growth, which is decelerating. Next chart. Then, again, inflation. So what drives inflation? Lots of different things drive inflation, but when we look at Ethiopia, leaving aside what's happened recently with global inflation, which is only adding to these trends. So we have growth of broad money supply. You kind of see they kind of go together, a little delayed effect. And then the rate of devaluation. So the dark green black line is the rate of devaluation. So when the line goes up, it means that the rate of devaluation has gone up. So you see these step increases where we had, these step devaluations. But even outside of the step devaluations, the rate at which, we do our daily or weekly or monthly devaluation changes over time. So what this chart shows us is that even though inflation is still spiking and going up, the rate of devaluation is going down, which means that we're building in, again, some overvaluation, because inflation and devaluation are tied. I'll come back to those in terms of policy implications. And the point is, this all feeds into why we have to make these changes that we're making. So, as I said, the most important liberalization we need to do, above and beyond all, I would replace all of them with this, is we need to get the exchange rate regime to be market-based so that supply and demand can be balanced by the market, which is really the only efficient, optimal way to do it. So let's understand our just background information, our forex inflows, and what drives them. The numbers at the bottom get packed a little bit because, okay, they're all, there's no one item that really dominates. But as you can see, at the top is remittances, followed by services, foreign direct investment, which is interesting because, okay, it goes up and down. We have numbers until 2021. What those numbers look like for 2022, I don't have yet, and then for 2023. But keep in mind, it's a fairly big chunk, 4 billion or so, and then grants and loans, and we can see the trend lines there. So the composition, in looking forward, it's useful to look at the composition to see which direction each one of these items might be going, and therefore what our forex inflows might look like, given kind of the current situation we're in and what we might look for next year and the year after. In terms of outflows, it's very clear. It's basically imports that dominate everything. This chart gets a little too messy, so let's skip it. But so the basic message that I'd like us to take from these charts is, A, inflation is spiraling. Devaluation, as painful as it seems to us, even the rate we're seeing now, the rate of devaluation is diverging from the rate of inflation. Where are we paying for this? Okay, even though imports have stayed fairly stable, but they've been compressed as our foreign exchange has diminished. So we've managed to kind of restrain the pressure on the currency and the black market and so forth by basically restricting quantity. By having restrictions on, until recently, okay, Franco valuta was allowed, having as tight a restriction as possible as to what LCs could be opened. So we were seeing long queues for people waiting to import goods, which basically means you have shortages in the market, which feeds into inflation, amongst other things. And we're in a vicious circle. We don't have enough foreign exchange. What have we done? Okay, we've tried to compress imports, but there's a real price to pay for that in growth and consumption. Okay, the fact that we restrain imports doesn't mean there's no price to be paid. Okay, which then also creates all kinds of economic rent opportunities for people to go around the system. So we have a lot of foreign exchange that leaks across the border. Okay, so the foreign exchange problem feeds into all the other problems we have, whether it's growth. Okay, we have to import everything. We're a very import-intensive economy. Never mind industry, even agriculture. Fertilizer is imported. Seeds are imported. Pesticides are imported. If we have commercial farms, we have imported machinery that need spare parts, that need fuel, etc. You know, we're opening up to foreign banks. Okay, they're going to come. And one of the things we should keep in mind is they look at Ethiopia and it's like, this place is strange. You can bring money in, but you can't take it out. It's like, I don't think there's any other market in Africa like that. Okay, so that's going to affect how they look at this market and the business models and how much foreign exchange they might bring. So even the liberalization measures we take are compromised by this one fundamental issue: shortage of foreign exchange. And as I said, this is, in our process, the last step that we're taking, that we need to take in this liberalization process, of which, you know, this conference and the opening up to foreign banks is one step, and not necessarily, you know, the biggest step. So the question is, you know, why don't we do this? Why don't we fix this problem? You know, we're letting foreign banks, you know, we're doing this, we're doing that. Well, these other liberalizations are policy measures. They don't require financial input. Okay, the liberalization of the foreign exchange regime requires that. Okay, if we decided, okay, we're just going to liberalize and let the market figure out how to balance supply and demand without intervening, the underlying shortages are still going to be there, and the exchange rate is going to balloon. And it's going to worsen all our other problems, including inflation. And probably, okay, would bring in some incremental flows, but it would be so disruptive to the overall economy that if we just let price determine everything without doing something to also balance the supply and demand side, that would wreak havoc with the economy. So what's to be done? As I've said, I'm not going to go into detail because I've spoken at this at length before. Basically, we have a supply-demand imbalance. What do we do? What can we deal with? So far, we've been dealing with the demand side and compressing that. And it's costing the economy. I don't need to get into the details of that. There's a price to be paid, a very high price, for just suffocating demand. That's basically suffocating the economy. So what can you do? We can look at the supply side. That's money. If we put money in on the supply side and we let market forces adjust the price, then we might not have a big spike. It can be managed. The big thing is, okay, so we've done the numbers, $4 billion, $5 billion, $6 billion. We'll do this. I mean, this session is not on that topic. And what happens after that? There's some bullet points in the Forum magazine. Can't be sure, but we estimate this initial investment of $4 or $5 billion will immediately, over the next year, capture more than that amount in foreign exchange that's slipping out of the system, whether it's remittances, illegal exports across the borders, all kinds of different things. We're not waiting for exports to kick in and make things right. Exports will kick in gradually over time. So, again, without getting into a lot of detail, that's not the agenda for this thing. This is the last step in the process of liberalization that awaits us, and which I'm quite sure is in process, and we've heard to that effect. So, just to wrap up this session, which is a background session, and Ato Work was here, and I'd like to introduce him properly. So this forum is not about the economy. That's just to set the background for the rest of the day and what liberalization means. It's not a small thing, it's a big thing. Again, I'll get into it in the afternoon session on what banking sector liberalization and the arrival of foreign banks will do for this economy. I think it'll do a lot. It's not going to solve all our problems. It's not going to do half of what exchange rate liberalization might do. So we're opening up. What does that mean? Well, number one, it's now we're going to have competition in the market for banking services. Some of you might say, well, we've had competition. Yeah, but we've kind of had the kind of competition you see between oligopolies. Nobody really wants to rock the boat. And the competitive models are not that sophisticated. There's nobody really coming out with different strategies, going after different markets. It's kind of a group movement. So bringing in foreign banks is going to bring in a whole new dynamic, which is going to bring competition, which is going to serve consumers better of every kind. So it's a big plus for the economy. For sector players, like I said before, it's an opportunity. For some, it could be a threat for others. But the big thing, and then leading into our next speaker, one thing we know for sure, the world, and banking in particular, even more so at the forefront of it, is digital. Everything is digital. And in the last few weeks, the National Bank of Ethiopia has mandated that all banks, all insurance companies, and all microfinance companies become fully digital within 2 years. I think that's great. Okay, that's actually 2 years, okay. We could argue about that. These things aren't simple to implement, require foreign investment, foreign exchange, hardware, software, getting to know the technology. Okay, well, that's change, but it's a good thing. It's a mandatory thing now. So one of the things that maybe local banks could have feared from the foreign banks coming in is like, oh, they're so digital and we're not. Well, okay, now we all have to be digital. okay? And that goes for banking, insurance, and microfinance. So this is always, big changes like this are an opportunity. Okay, the reason for this conference is to really raise that point and also make, industry players aware that government is also aware that the world has gone digital. One of the 5 major pillars of the 10-year homegrown economic plan is digital transformation. Everything I've said for the banking sector applies to the rest of the economy as well. And one of the things I've come to know recently is that actually quite a lot of progress has been made in this regard. And there is an institute, the Artificial Intelligence Institute, of which Ato Warku is the Director General, and he'll speak to us. I'll let Ato Warku speak, but they've created an institution which has built quite impressive capacity from what some people that know the African digital landscape tell me. The data center that's been installed at the Artificial Intelligence Institute, AII for short, is on par with anything they've seen in Africa. Actually, they haven't seen anything like it in Africa. So this is the hardware. So all banks, insurance companies, microfinance companies, if they want to go digital, what's the first thing? One of the things they need? They need hardware. A data center. Fortunately, one is on its way. Second is software. Hardware without software. So second part of our presentation is to introduce the audience to the latest in digital technology, from China, beyond what we might have in Africa. And actually in the banking sector, Africa is leading the world in many ways. But there'll be a presentation from the Whale Cloud Group on what they're doing in China, what they're starting to do in Africa. Across the technology, they cover everything from, smart government to smart city to smart industry to smart everything. We're going to focus today on smart finance. And then in the afternoon session, we'll go into more detail on kind of the state of the banking industry and the foreign banks coming in and how that's all going to play out. So very long-winded background and context for the rest of the day. So with that, I'd like to stop for now and introduce Ato Warku, who's the Director General of the Artificial Intelligence Institute, who has very graciously agreed to say a few words about what the Institute is, what its plans are, and how you might be of service to this audience and the sector it represents. So thank you.